Hi, my name is Jake Barber. I'm the principal of SJB Global, and we specialise in helping UK and US expats overseas. Today I'm going to focus on retirement planning for Americans in France. So if you are planning to move to France, it can be one of the most favourable countries with regards to the US and French tax treaty, but there are certain things that you have to be aware of. So first of all, we're looking at retirement accounts. Each different retirement account is going to be taxed based on what the treaty says. So if you look at, for example, your standard 401ks and traditional IRAs, these are actually going to be taxed in the US generally, which is much more favourable because if you look at the income tax brackets in France, they are extremely high, meaning that you end up paying a much higher tax rate. Other accounts such as Roths generally would be tax exempt in the US, but this may not be the case in France, and it's very important to make sure you document things correctly to avoid paying unnecessary tax. One thing you need to be very aware of though is France don't recognise trusts. So the US works off of common law, whereas France works off of civil law, and trusts are not recognised under civil law because they follow what's called forced heirship rules. So if you do have things like living trusts which are revocable, it's a good idea to make sure you can speak to someone to find out whether or not you should close these down whilst you are still a US tax resident, to avoid unnecessary penalties and problems whilst you are a French tax resident. A big problem though in France, or I say problem, but thing that you need to be aware of is there are restrictions to custodians and investment options. So a lot of the custodians will not allow you to set up new accounts whilst you're a French tax resident, which means it's best to get your planning set up at least more than 90 days before you move. And the reason why I say 90 days is because if you update your address within 90 days, often the custodians will tell you to close your account down because you've effectively created the account whilst you're about to move to France. Whereas if it's more than 90 days, they will allow you to keep the account open depending on who the institution is. So in Europe, you have something called MiFID, which restricts certain investment vehicles to residents in Europe. And this can be quite problematic because being an American or being US connected means that if you buy an investment, so a fund or an ETF which is domiciled outside of the US, you'll end up with something called PFIC, which stands for Passive Foreign Investment Company, and you will pay ordinary income tax on the growth within those investments, plus other penalties may apply too. So this means you effectively only want to be buying either US domicile funds or ETFs or direct shares and bonds anywhere around the world. And the problem in Europe is they restrict you to not being able to buy US domicile funds or ETFs. So if you can't buy US domicile funds or ETFs and you can't buy non-US domicile funds and ETFs, it means the only options you've got available are to buy either direct shares or direct bonds, which makes the investment strategy somewhat more difficult. And what we do as a company is we work alongside money managers who have PFIC compliant investment products which allow you to buy, for example, the type of portfolio that you want. If you do set things up whilst you're in the US or whilst you're outside of France where maybe there aren't these restrictions, it does mean you can keep these investments in place, but if you've got dividends that are getting paid out, for example, into cash accounts, these can't be reinvested into US domicile funds or ETFs. So this does mean that it's really, really important to make sure you can work with a financial advisor that understands what these restrictions are. They also understand which institutions allow you to place investments, and they also understand what the taxation treaties between the US and France states with how each account is going to be taxed. And also another thing to be aware of is how estate tax and wealth tax in France also works as well. So in general, there's many different tax rates that you need to consider. It's not just the US you want to look at, it's the US, France, and how the US and France works combined.